Preparing for a finance manager at Exelon interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you are interested in a finance manager role at Exelon. I see the finance manager role as translating operational performance into decisions that protect reliability and capital discipline. At Exelon, that means understanding regulated utility economics, forecasting cash flow and earnings, and partnering with operations, regulatory teams, and executives. I would bring disciplined planning, transparent assumptions, strong controls, and concise communication. My objective is not simply to explain variances, but to identify their drivers and recommend actions that improve financial and operational outcomes. While answering, focus on your finance progression, leadership experience, analytical strengths, interest in energy infrastructure, and ability to connect financial discipline with reliability, affordability, regulatory obligations, and long-term stakeholder value. Question 2. Why do you want to work for Exelon? Exelon interests me because its businesses operate essential infrastructure where finance directly affects customers, reliability, and long-term investment. I am attracted to the combination of regulated economics, complex capital programs, and the need to balance affordability with grid modernization. My background in planning, performance analysis, and business partnering fits that environment. I would value helping leaders make well-supported decisions while maintaining strong governance and accountability across a large, operationally critical organization. Make sure to cover Exelon's scale, critical infrastructure mission, regulated operating environment, decarbonization relevance, customer impact, and how your finance skills can support reliable investment and responsible cost management. Question 3. How would you build an annual budget for a regulated utility? I would begin with the operating plan, regulatory assumptions, customer and usage forecasts, approved rate structures, and major capital initiatives. Then I would build expense and revenue models by driver rather than applying arbitrary percentages. I would validate labor, maintenance, storm, technology, and financing assumptions with owners, run downside and upside scenarios, and reconcile the result to cash flow, earnings, and regulatory commitments. Finally, I would document assumptions, secure accountability, and establish monthly monitoring. In your answer, talk about revenue drivers, rate assumptions, customer volumes, operating expenses, capital plans, labor, regulatory requirements, scenario analysis, ownership by budget holders, and reconciliation to strategic objectives. Question 4. How do you forecast earnings and cash flow when conditions are uncertain? I separate structural drivers from timing noise and forecast each explicitly. For earnings, I would model customer demand, approved rates, operating costs, depreciation, and financing impacts. For cash flow, I would emphasize collections, capital timing, working capital, storm costs, and funding requirements. I would maintain base, downside, and upside cases, identify sensitivities, and refresh the forecast as facts change. Management should understand both the expected result and the risks surrounding it. Be sure to mention driver-based modeling, probability-weighted scenarios, timing differences, liquidity needs, sensitivity analysis, rolling forecasts, management judgment, and clearly communicating uncertainty rather than presenting false precision. Question 5. Walk me through how you would analyze a monthly budget variance. I first confirm the data and compare actual results with budget, prior year, and the latest forecast. I then decompose the variance into volume, price or rate, mix, timing, productivity, and unusual items. For example, a maintenance overrun may reflect storm response timing rather than poor cost control. I discuss the explanation with the responsible operator, assess whether the variance affects the full year, update the forecast if necessary, and document an action-oriented conclusion. Focus on separating volume, rate, mix, timing, productivity, and one-time effects. Validating data with business partners. Determining whether issues are controllable, and translating findings into specific corrective actions. Question 6. What financial metrics would you monitor for Exelon and its operating utilities? I would monitor earnings and operating cash flow, but I would not stop there. Key measures include O&M performance, capital deployment, rate base growth, allowed versus earned returns, customer growth, usage trends, liquidity, leverage, and forecast accuracy. I would also connect financial results with operational measures such as reliability, project milestones, and storm activity. The strongest dashboard shows how operational drivers create financial outcomes, helping leaders act before a variance becomes a year-end issue. Mention earnings, operating cash flow, capital spending, O&M, rate base growth, allowed returns, customer and usage trends, reliability-related indicators, liquidity, leverage, and variance to approved plans. Question 7. How would you evaluate a major capital investment in grid infrastructure? I would evaluate the project through both financial and public service lenses. First, I would confirm the reliability, safety, compliance, or capacity need and determine whether regulatory recovery is likely. Then I would model construction spending, timing, depreciation, financing, operating benefits, customer impacts, and downside cases for delays or cost overruns. I would test NPV and return measures, compare alternatives, and define milestones. Approval should include a clear owner and a post-investment review. In your answer, cover strategic need, reliability and safety benefits, regulatory recovery, customer impact, NPV, scenario analysis, construction risk, schedule, cash requirements, and post-investment performance measurement. Question 8. Explain the importance of rate base in a regulated utility finance role. Rate base represents the investment in utility assets that regulators generally allow the company to recover through customer rates, together with an approved return. Its growth depends on prudent capital investment, in-service timing, depreciation, retirements, and regulatory treatment. I would monitor whether projects enter service as planned and whether costs remain eligible for recovery. Rate base affects long-term earnings potential, but it does not eliminate execution, regulatory, financing, or customer affordability risks. Make sure to explain rate base as the regulated investment base, its relationship to allowed returns and depreciation, the importance of prudently incurred costs, and why timing and regulatory approval affect earnings and cash flow. Question 9. Describe your approach to managing operating expenses without compromising reliability or safety. I would start by understanding which costs protect safety, reliability, compliance, and customer service, rather than applying an equal reduction target. I would analyze spending by driver, distinguish recurring costs from temporary items, and identify productivity opportunities such as process redesign, procurement, or workforce planning. Any proposed reduction would be tested with operations for risk and timing. Sustainable savings should improve efficiency without deferring necessary maintenance or creating larger reliability and remediation costs. Discuss zero-based challenge where appropriate, driver analysis, productivity opportunities, prioritization, safety and reliability guardrails, cross-functional review, and avoiding short-term cuts that create larger future costs. Question 10. Tell me about a time you influenced an operational leader using financial analysis. In a prior role, an operations leader planned to accelerate spending because a project appeared behind budget. I rebuilt the forecast by work package and showed that the issue was mainly timing, not an annual shortfall. I explained the analysis in operational terms, proposed a milestone-based release of funds, and agreed on weekly monitoring. The project finished within the approved annual budget, while the leader retained flexibility. That experience reinforced that finance gains influence by being practical and accurate. Be sure to structure the example with context, analysis, stakeholder concern, communication approach, recommendation, measurable result, and what you learned about building credibility with non-finance partners. Question 11. How do you ensure financial reporting is accurate and delivered on time? I establish a close calendar with clear owners, deadlines, dependencies, and escalation points. I prioritize reconciliations for material accounts, review unusual movements, confirm accrual support, and compare results with operational drivers. I use standardized templates and automation where possible, but retain review controls and documented evidence. Before distribution, I challenge significant variances with business partners and ensure the narrative matches the numbers. Reliable reporting comes from repeatable processes, not last-minute heroics. Focus on close calendars, reconciliations, review controls, data ownership, materiality, variance analytics, automation, escalation procedures, documentation, and balancing speed with dependable reporting quality. Question 12. What internal controls are especially important in a utility finance environment? I would focus on controls over capital authorization, procurement, invoices, payroll, revenue completeness, journal entries, account reconciliations, and financial reporting. Segregation of duties and system access are particularly important in a large organization. For capital projects, I would verify approved scope, spending authority, in-service dates, and supporting documentation. I would also ensure regulatory schedules reconcile to the ledger. Effective controls should prevent errors, detect exceptions quickly, and produce evidence auditors can evaluate. Mention segregation of duties, capital project authorization, procurement and payment controls, revenue completeness, journal entry review, account reconciliations, regulatory support, access controls, and timely remediation of deficiencies. Question 13. How would you manage a material forecast miss discovered late in the quarter? I would first validate the miss, quantify its earnings, cash, and covenant or regulatory implications, and determine whether it is timing-related or structural. I would immediately inform the appropriate leaders rather than waiting for perfect information, presenting the known facts and key uncertainties. Then I would rebuild the affected forecast, identify corrective actions, and establish tighter monitoring. Credibility matters most in that situation. Transparent escalation gives management time to respond and prevents a surprise. In your answer, emphasize rapid fact-finding, materiality assessment, transparent escalation, root cause analysis, forecast re-estimation, scenario impacts, corrective actions, and preserving trust with senior management. Question 14. How do regulatory changes affect financial planning and analysis? Regulatory changes can affect revenue, recoverability, capital timing, operating requirements, and the period in which costs are recognized. I would work with regulatory, legal, operations, and accounting teams to translate the change into model assumptions and timing scenarios. I would assess customer impacts, regulatory lag, cash needs, and whether spending is recoverable. The forecast should clearly distinguish approved treatment from management expectations, so executives understand both the base case and the exposure. Discuss rate cases, allowed returns, cost recovery, environmental or reliability requirements, customer affordability, regulatory lag, scenario modeling, documentation, and coordination among finance, legal, regulatory, and operations teams. Question 15. Describe how you would prioritize competing requests from executives and business units. I prioritize requests using a transparent framework, safety and compliance first, then regulatory deadlines, material financial impact, strategic importance, and decision urgency. I clarify the decision required, the minimum useful analysis, and the deadline before committing resources. If priorities conflict, I explain the trade-offs and propose sequencing rather than silently delaying work. I also protect recurring close and control responsibilities. That approach keeps finance responsive while ensuring critical obligations are not compromised. Make sure to cover strategic alignment, materiality, regulatory and safety urgency, decision deadlines, resource constraints, stakeholder communication, transparent trade-offs, and maintaining service quality for recurring finance responsibilities. Question 16. What would you do if an operations team challenged your financial assumptions? I would treat the challenge as useful information, not resistance. I would ask which operational assumption they believe is unrealistic, trace both views to source data, and separate factual differences from judgment calls. Then I would run a joint sensitivity or alternative scenario and make the consequences visible. If disagreement remained, I would document the assumptions, explain the risk to leadership, and recommend the most supportable case. Strong partnership requires finance to challenge constructively and remain open-minded. Focus on listening first, tracing assumptions to source data, testing alternatives, separating facts from judgment, using joint scenario analysis, and resolving differences through evidence and shared business objectives. Question 17. How do you lead and develop a finance team? I set clear standards for accuracy, timeliness, ownership, and business partnership, then connect each person's work to the team's objectives. I use regular one-on-ones, review analytical outputs, and coach both technical judgment and communication. I delegate meaningful ownership while remaining available for escalation. I also create opportunities to present findings to stakeholders, because confidence grows through practice. My goal is a team that can challenge assumptions independently while maintaining consistent controls and service quality. Mention clear expectations, role ownership, coaching, review routines, technical development, communication skills, succession planning, psychological safety, recognition, and accountability for accurate, timely business support. Question 18. Give an example of improving a finance process or report. I once replaced a manually consolidated monthly report with a standardized driver-based template linked to approved source files. The old process required several days of spreadsheet comparison and created inconsistent commentary. I mapped the data flow, added validation checks, assigned ownership, and trained users before implementation. Reporting time fell from 3 days to 1, and review quality improved because variances were categorized consistently. I measured adoption after launch and refined the template based on user feedback. Be sure to explain the original inefficiency, root cause, solution design, technology or standardization used, control considerations, measurable benefits, adoption strategy, and how you sustained the improvement. Question 19. How would you communicate complex financial results to a non-finance executive? I would lead with the headline, quantify the financial impact, explain the operational driver, and state the decision or action required. For example, instead of presenting multiple accounting variances, I might say that storm activity increased costs by a specific amount and reduced the annual forecast unless recovery timing changes. I would use a simple trend or bridge, separate facts from assumptions, and keep technical detail available in backup. Executives need clarity, implications, and choices. Discuss leading with the headline, using plain language, connecting numbers to operational drivers, highlighting implications and decisions, limiting technical detail, visualizing trends, and confirming the audience's required action. Question 20. What would success look like for you in your first 90 days at Exelon? In the first 30 days, I would learn Exelon's business model, organization, planning calendar, reporting requirements, and key regulatory drivers while meeting operational and finance partners. By day 60, I would independently understand major variances, control dependencies, and forecast risks. By day 90, I would deliver a useful improvement, such as clearer driver reporting or a streamlined review process, with stakeholder agreement. Success would mean earning trust, producing dependable analysis, and identifying priorities for longer-term value. In your answer, cover learning the business and regulatory context, building relationships, understanding reporting and planning processes, identifying control or process risks, delivering an early improvement, and establishing measurable priorities. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.